Good morning. How's everyone?
Hi, morning, Nathan.
Morning. Do we have somebody from Project One, Automated Dealer Market Making and RFQ Response? Oh, James.
Hey, good morning.
If not, let's move on to Project Two, Corporate Bond Transaction Cost Analysis, because we have Vijit and Yu Yang on here. So
Hey Nathan, can you hear me?
yeah, yeah,
Yeah, we good?
Yeah, I'll
yep,
share the screen.
yep.
Sure. Give me 1 second.
Okay. Yeah, can you see it?
Great. Hey guys. Yeah, we can see it. Thanks, man. So yeah, I think the progress has been pretty good with respect to our project. We have started making the research paper. We have our first draft ready as well. At the same time, all the like whatever goals we had started out with, we have pretty much reached all of them, and that is what we'll be sharing today. This is pretty much the ending part of our project, which is grading the traders, which is basically trying to rank the traders and at the same time trying to look into the conditional probability of the trades. Next slide, please. Yeah. So yeah, so every TCA system has a dial, right? Like how many trades do you flag for review? And nobody reviews half the book. A real compliance desk looks at the worst few percent. So the number that actually matters is when the system raises an alert, how often is it right? Now, if you look at the bottom row here, at 5% flag rate, a realistic review load TPMM is right 81% of the times, while the industry standard last trade is right about 73% of the time. So DPMM is already doing better there. Uh, so the chart on the right that you see makes this much more concrete. Of every 100 trades TPMM flags, 81 are genuinely poor executions and 19 are false alarms. While for the last trade, the number completely reverses, with 73 being poor executions and 27 being false alarms. So we are doing much better there. Roughly 1.5 times fewer people chasing trades that were pretty much fine. Now, if you look at the top row here, because this is part that surprised us at a 50% flag rate, that the two are identical. Last trade is even ahead, even a little bit ahead in that aspect. So what needs to be understood is that when we look at F1 score, it's an average of precision and recall, right? But when we are dealing with systems where not everything is a false alarm and the percentages can be skewed, F1 might not be the best measure to go with, and what we had the last time, those were the best measures to go with. So that is how we are starting this. Next slide, please. Yeah. So the top row is exactly where F1 is measured. F1 is a single number evaluated at the median threshold. We flag half, clear half. That is pretty much what F1 is doing. That is precisely that one operating point where the two benchmarks agree. So every time we computed H1, we got a tie and concluded there was no difference. The model was never the problem, though. The measurement was pointed at the one spot where there is nothing to see. And the chart shows the whole curve instead of one point. Yeah, the table states that the same thing properly, conditional on the truth. So we are basically saying that, hey, we flagged something, was it truly bad? Or we cleared something, was it something which was truly bad? So we want to, be flagging things which are truly bad, which DeepMM is doing much better. And we want to clear stuff which is truly good, which is again DeepMM, which is better than the last trade. Next slide, man. Next thing we looked into was trading the ranking, and we have ranked the desks first, of course, and we have looked into different ways of going about this. So DeepMM grades individual trades better. The natural next question is whether it also ranks desks better. And here the answer is much more interesting than a clear, clean winner. First caveat I want to be upfront about, there are no trader identifiers already in the data that we have seen. Traders are pretty anonymous. So what we have done, I'll tell you more. So these aren't desks in literal sense. They are different trading styles, which are divided by size, side, which side you're on, buy or sell, liquidity, staleness, and credit risk. So based on these five things, we have made multiple blocks, and then we have decided on, okay, these are the sums. These, for example, if there's a trade is of huge size, on buy side, high liquidity, less stale, and how is the credit risk looking? This is just one category of trades that we are looking at. So we have made different categories based on these factors. And the result on the answer key built from trade dealer codes independent of trace, DeepMM's rank is 4 times closer to truth. So you can see 0.48 against last trade, which goes to 0.12. Basically saying that now that we have categorized different trades, we are saying that, okay, different category of trades probably belong to different types of traders. And DeepMM is doing much better in ranking them compared to last trade. Next slide, please. Okay, so why the trade derived key flatters last trade? Here's what is actually happening. So if we split the cohort by how old the previous printed price was, we can look into stuff as fresh, medium, and stale. And this is where DMM is kind of failing at times, which we realize is the stale quotes. Now, why it is failing at times at the stale quotes is the question. So if you see the orange bar, last trade 174, there are 437, 813, they rise together in locksteps across all the cohorts, right? They have a correlation of 0.88, by the way. And it's very mechanical. So if the trade stays stale for longer, last trade kind of says that, hey, the measured cost is going to be higher. However, DMM is not saying that. Last trade's ranking advantage isn't skill. So it's like, yeah. So the DMM is saying that, okay, the trades which were stale, the cost isn't high. Like it's not giving it much high cost compared to last trade. The reason being that how we are calculating the cost itself is based on if something is available until a particular threshold. Right now, our threshold being 30 minutes to 1 hour, right? That is also playing a role into this picture. So yeah. Can you go to the next slide? Now we come to the literature review and our research paper part. Yu Yang will be taking over.
Yeah, sure. Okay, so for the literature review, this slides and next slides will be literature review and our gaps. And there's no reference price at all. So basically, the paper from Edward and his fellow research shows that the reference price, which is a ground truth, is not discovered. So basically, each researcher will just pick one benchmark and do the according research without actually validating whether this benchmark is good or not. And the midpoint is also what Harris kind of involved. So there's one exception: science trades off the same midpoint it matters against. And the AI reference price, there are paper like the very new paper that have reference for AI, and it says that it beats the last trade, but also it asks for price discovery. And the evaluation bias is also here. So basically, it's the same as the ground truth, meaning that we only have a benchmark to use, but it is unclear how we evaluate those benchmarks. And the gaps is quite naturally the next step. So the first is there's no head-to-head comparison. Like I said, 3 benchmark generation, they coexist, but no paper try to compare them. And then there are no per trade labels. So nobody give trade a benchmark against a separate answer key to label this trade as a good trade or bad trade, especially to label those benchmarks. And then no usable ground truth. Because there are no usable ground truth, therefore the comparison is impossible. And our solution kind of resolve all these 3 issues.
Yeah, not a limitation part. Basically, we saw the majorly these three limitations right now with our research paper. The first one is that we realized there's one paper by who was the guy again? Give me 1 second, please. Yeah. There was one paper that we came across, and it basically said so. What we have seen, first and foremost, is that if the size of the trade is very high, the cost will be very high as well. However, one of the papers said that it isn't exactly the case. At times, the high size also gives low cost. Majorly, the reason being that the client tends to get some level of benefits for such high trades. So that was one of the things that we saw. What we are doing right now in our method is that we are subtracting the median cost for each trade size, side, and liquidity. Which and but each trade size, the average cost of this particular group, for especially for the big trades, we are at least this paper says that that is what we are might be overestimating on our end. Okay, so that is one thing where we should be looking into a little bit more, maybe. Second part that we looked into is we reduced the shared provenance problem. We did not eliminate it completely. Oh, wait. Yeah. Give me 1 second. Yeah, sorry. The second point being that the key only labels a subset. It needs quotes on both sides inside window, which tilts the sample towards actively traded bonds. Every number in this deck is conditional on that it should be actively traded. The more actively traded we are, the bond is, the much better we are at telling how good it is doing. However, when it is not that actively traded, when it is not hitting that threshold that we are looking at, then we are not so sure about our answer. But that is a problem that you're always going to have. You will never be 100% sure about how you are rating it. The more liquidity that you see with bonds, the more sure you are going to be. But however, it is still a limitation, and we do have written it there. And the last part is that it is only it is only done majorly for deep MM. It is not done for any other system of proprietary software out there. So we have not made any comparison to any proprietary software out there, but we have at least shown it with deep MM. We are sure about a training set of deep MM, but we are not sure about whatever training set others are using. Now Yang will be sharing the dashboard that he has worked on, and whatever I've worked on, he has integrated that in the DeepMM's website, and it's a difficult job, dude. It's a very difficult job.
We're actually running low on time, but this is a good presentation. So I don't think we have time to go over the dashboard, but I will say I've seen it and really good progress on that. So thank you. Just one thing though, Yang, you were also doing some research into, which is more accurate, the price when converted to spread or the spread model when evaluated in spread.
Yeah.
And yeah, so I think you have good results. The one thing I wonder if you could do, if you haven't done it already, is to weight it by DV01, because if you just do, like, for example, the MAE or median or 75th or 95th percentile errors when evaluating spread without weighting in DV01, it doesn't account for the actual economic consequences of the error, if that makes sense.
Sorry, could you repeat, like, weighted by what?
DV01
DV01?
or
Okay.
or something approximating DV01, the duration.
Okay. Oh,
Okay.
okay.
And then does anybody have any questions for Yu Yang and Vijit on transaction cost analysis? Okay, cool. Do we have James, you're online. Do you want to go over project one?
Yeah, sure. I can screen share real quick.
Oh,
All right, you can see this fine.
yeah.
All
Easy.
right, so we have project one. We have the corporate bond market maker simulator, and in our last presentation, we talked about we just implemented regime C, and then we were making a bunch of different parameter graphs. But one of our issues was our parameters were completely off. For example, our risk cap was 5 million, which is kind of incomparable to real life. Um, and then so when we said next we would work on the platform fees, which we implemented. and then the competitive analysis. So we were still having a little bit of trouble getting consistent Sharpe ratios. As a matter of fact, we were negative for a lot of the time, and then we would have to start on the research paper.
Okay, so to get it to like run at larger sample sizes, so like 1 million or higher, we made a bunch of optimizations. But like the main ones we did was when constructing a new sample, we would only sort like the RFQs every like few chunks instead of every RFQ. And then we also implemented vectorization for when constructing the RFQs and scoring the quotes. And then we touched up like more upon skipping like expensive calculations when the RFQs are invisible. And did we made it so like when doing the multi-processing at the end, all the workers shared the same block of data instead of recreating each block of data per worker to say which saved a lot of memory. And we also just pre-computed some combo values that were shared by all the combos. And then this has allowed us to reduce our execution time at 1 million sample size from 41 seconds per combo to 14. And it's made it so we could reduce our memory footprint per worker from 9.8 gigabytes to 0.9, allowing us to have more workers.
So unfortunately, we're still having some issues with the backtest performances right now. But we were having for a while, we were getting consistently like negative or near zero Sharpe ratios, which was nothing. But we did a lot of debugging for like a couple of days. We just spent doing nothing but debugging and trying to see what we could do to get the Sharpe ratio to be higher. Um, so in our most recent run, this is only one quarter. This is 2024, quarter one. But the issue we had, I mean, the good news is we're out of the negatives. We're actually into real usable Sharpe ratios now. We ran 96 combinations, and then almost all of them were positive. But the issue is it's not really realizing anything. It's just kind of adding spawns to inventory and just keeping it. So we haven't implemented unwinding and we haven't implemented force closing. So if we do that, the Sharpe ratio might change drastically. But until then, we're glad to be out of the negatives. So yeah. So we did some more parameter sweeping, parameter research. This is all just in case we wanted to present another research paper maybe on which parameters, the specific parameters to use for an optimal market making algorithm. But the ones we did is the risk cap, which is intuitive, just the max amount of risk, the max amount of inventory. The wind down days, so sometimes at the end we will wind down, which means we'll be more strict on adding inventory and we'll only lose inventory. Well, obviously in this case it doesn't really matter too much, but inventory punishment, again, we make trades that we prefer trades that gain lose inventory that gain it. So um and then the user adjustment dollars. So basically how tight our objective function is. So are we more lenient on which trades we pick or are we more strict on the trades we picked? And then model noise is just kind of adding random incorrect values to the ladder, to the percentiles. So the risk cap was one of the biggest changes. So
Going
I'll
back
talk
to
about
that,
that a little bit. Say it
sorry to
again?
interrupt. I have a question about the previous slide.
Sure.
When you're doing parameter sweep, like the model noise wouldn't be a parameter that you're trying to optimize because like obviously
No.
ideal. Okay. But
Yeah,
it's
yeah,
just one of
yeah.
the things that you varied when you've experimented, right? Okay. Yeah.
Exactly. It's just kind of there, just kind of yeah, I don't know, it's just kind of there. We just read it for this case. We're not actually trying to optimize the Sharpe ratio. We just have it just for our information.
Yeah, just to try a lot of simulations with different parameters.
Exactly.
Yeah, so like the next phase after this probably is about how do you optimize your parameters without overfitting them to a particular quarter, right? Because you
Yeah.
could overfit, for example, number three, the inventory punishment, because like during a certain time period, it might be really advantageous to be owning a lot of bonds long or short or whatever.
Mhm.
And others it will be bad.
Yeah.
So maybe that's something that you play with and then just keep steady, maybe. So
Yeah, I agree. Yeah. Yeah. This list goes in order from most difference on the Sharpe ratio, so least difference, excluding model noise. And obviously a lot of difference, but so the risk cap adds a lot of difference. I guess 2 billion is too tight, and 5 billion is essentially no risk cap. So we haven't figured out if there's a risk cap that could benefit the program yet. Maybe we could play with that more with either bigger risk caps or like more precise, like 3 or 4 billion or 1.5 or something, but we haven't figured out a way to increase the Sharpe ratio with risk cap yet.
But generally it looks like the bigger the risk cap you have,
Yeah,
or the bigger your Sharpe ratio. Is that the Sharpe ratio on the
exactly.
y-axis? Yeah.
Exactly.
Yeah.
Um, the wind down days doesn't have too much of an effect, but again, most of our algorithm is based on just kind of buy and hold. So the wind down days might not have too much of an effect, but if anything, no wind down days at the end. Um, so as to help a little bit more. Same with inventory punishment, not too much of a difference. But again, this might be now that we know that 0.001 inventory punishment actually does make a difference. Now we can play with different numbers and we can see if we can get an even higher Sharpe ratio by changing it. Now that we know that it actually does matter. Not too much here, but it does make it is technically better. But for now, not that big of a difference. And then almost no difference here. But again, the difference is we have a higher Sharpe ratio with -1,000. So if we try different numbers, we can get different results. But um, if we're a little bit more strict with -1,000, then we get a little bit higher Sharpe ratios, but very similar, very similar. And then the model noise, as we were showing, this is more just like out of curiosity. The zero point 0.4 could be a little bit useful because I think that's how we compare it to our previous model. I think you said that the our current model with zero point 0.4 noise is kind of comparable to our previous model. We can use that in a paper.
Yeah, I mean, if we're comparing with maybe C++ or or not C++, CP
CPU, yeah.
plus, or we're just using the last traded price, is probably somewhere between zero point 0.2 and zero point 0.3 or 4 would be my guess. So,
Yeah, so
but
that
yeah,
one is
this is actually the main result of the project because like because you're proving here that obviously the accuracy of your input um, matters a lot in terms of the performance of your simulated market maker. So.
yeah, so this was just kind of just for fun, but so we know it now, we have that now. And the best part is previously it would be random, and then a lot of our best runs would have model noise of like zero point 0.4 or something, and they would be confusing. Now it's intuitive again. Now it's back to making sense.
Now that you've worked out all the bugs, or
Yeah.
at least some of the bugs, yeah.
So our next steps that we're going to work on, we still need to work on longer simulations. So we still have lower Sharpe ratios for if we want it for 1 year, and I'm sure that has something to do with the inventory accumulation. But we're gonna test that out. Um, the parameter research again, we can fine tune the parameters and find out if bigger or smaller parameters for each one would be better for Sharpe ratios. And then again, a research paper, which we can do either a big research paper with everything, or we could do two research papers, one saying we made a simple algorithm with simple parameters and it ended up being positive, and another saying if you're going to use our algorithm, here's the perfectly bet like the optimal uh parameters to optimize Sharpe ratio.
Yeah. And if I were to add one thing here, I would say just a
Sure.
lot of focus on preventing overfitting. So like maybe doing a lot of tests like where you do a parameter sweep during one period and then you test it on another period, but only do it once, so that you're not overfitting to the new period. Or you can actually do it on many periods where you do end full cross validation on different time periods where you slice the time into different quarters or whatever.
For
Uh,
sure.
there is a new Atlas 1.1 data set that I can send you guys, so remind me to send that to you.
Yeah, for sure.
And the model's about 4% more accurate. Um,
That
and
is
then
also kind of what we have here.
yeah,
we said over a year, but we also said across multiple seeds. So like we're gonna check over.
Yeah.
The idea is like we check over like 2024 Q1 is how we got the parameter data that I just showed you, and then we say, all right, is it the same thing for 2024 Q2 or 2023?
Yeah.
So we'll see.
Awesome. And
Wait,
all the results you showed so far, they're with the platform fees taken into account?
Yeah, indeed.
Awesome. Okay. Then
is the new Atlas model available through the API?
yeah, that's what's actually in production right now, and
Uh,
and on the staging server. And I have a new like historical trade matched set of data files for the last 3 years or so.
Sounds good.
Um, and George, do you have any questions for James or Ethan on this project?
Can me, Mike, just to be sure.
Say it
Everybody,
again.
Hey, Nate, are you asking me?
yeah,
Just to be
I'm
sure.
just curious if you have any questions for Ethan or James over this project they just went over.
Over the backtest.
Yeah, over
Yeah,
this simulation. Yeah.
maybe quick question here. You mentioned that you have the logic like buy and hold. Can you quickly describe how do you think about the coordination in between entering the position and exiting the position?
Yeah, it's kind of a bug of ours. We don't intend to do a buy and hold. We were supposed to do more of like we're gonna implement unwinding and we're gonna implement what's it called? Force closing. We haven't thought through that yet, to be honest.
Well,
I honestly I just we found out that the we made our Sharpe ratios non-negative like 2 days ago, like Saturday night, and then we just found these graphs. We just found them last night, so this is all kind of new to us.
um,
But
one question. Do you in your objective function, do you have a bias towards risk adjusting, or sorry, risk decreasing trades? So like, in other words, there should be a bonus in the objective function that incentivizes it to get rid of a position if it's risk decreasing, like either for net risk or gross risk.
I
Yeah,
mean, we have
yeah.
the one that favors less inventory, the one that favors selling rather than buying, which is kind of comparable.
Yeah. Yeah. And I guess the other thing to work on too is probably to George's point is to um, not just calculate the gross or net risk, but look at like the DVO1 risk if you can calculate that.
Got it. We'll
We
look
have
into that
reference
file.
data, so you can use that for DVO1 risk.
Yeah, and a quick question here as well, maybe before the next one. When you because I'm not familiar with the details here, when
Mm.
you make a decision to enter the position, you use and across the backtest, you use only price, or you rely on some types of spreads like G spread and other types of spreads.
We use the spread. We have an objective function and we use the spread.
Use a spread. What type of the what the spread?
It's just a benchmark spread.
The benchmark spread. Okay. Okay, I see. And in terms of you're describing this as a bug, but in terms of the logic itself to enter and exit position, how do you think about the logic? Do you, because it's very important in terms of the risk that, for example,
Mm.
you in the beginning, let's say of the day, you're unloading the book, for example, because at some point you can achieve the cap of the portfolio, let's say by the risk or by the capacity, and you need to unload the portfolio before you're gonna load it again. And typically,
Mm.
because of the probabilistic nature of the execution, you do this in iterations. You can't do it, like just sell and then buy. Also, it depends on the type of the execution. How do you think right now? Maybe just a quick, a quick feedback about the logic of, or let's say, let's describe it in the way. How do you think you want to construct it?
Got it. I think you're talking about the objective function.
Yep.
So if yeah, so we go through I forget all the details of the objective function, but we go through the risk, we go through how big the spread is, the expected value, we calculate the expected value, we subtract um, penalties for the inventory. If we have too much inventory, we don't want to get more. We subtract, what else do we subtract? We have this is kind of a list, essentially. There's more to it.
Okay. Well, maybe I don't want to hijack the call, but Nate, yeah, I have some questions. Maybe I can
Yeah, we can take them
tell.
offline. I can
Yeah.
introduce you
Yeah, for
guys.
sure.
But I would say like going back one slide again to those graphs. I think maybe your main goal for next week would be to just get the blue realized P&L line to be going in a positive direction
Yeah, 100%.
along with the mark to market. So yeah. Oh, cool. All right, so let's move on to project 3. Thank you, James and Ethan, for the hard work on this. So the
Thank you.
macro-economic corporate bond price forecasting with uncertainty. Do we have somebody online for that project?
Yeah, I'm here. Give me 1 second. Let me share my screen.
Sure.
Can you see it right now? So here, we have some new update from the last week. So the project here now stands alone, like a standalone, live bond price focus and stronger scenario conditional repricing engine with student T predictive distributions and temporal robust testing, a new 30-day horizon, and hypothetical risk and credit stress analysis. So here, as we talked last time, the primary metric here is out of sample MAE, and our baseline is just a carry forward forecast. So here, our probabilistic metric is validation stack is student T and student T negative likelihood because the target here is a predictive distribution. So NIL is a main secondary metric and distribution family, degrees of freedom and residual scale are selected on validation and locked before test evaluation. And here we also report the 90% interval coverage together with the interval width. And our cover result here, here is our current result. The first part is the full test point focus result. And here is point focus. And the last column here is improvement versus carry forward. The main performance result here is that at the new 30-day horizon, the supply scenario model reduces the full test MAE from 1.12 to 0.83, which we have like a 26% improvement versus here. This is the strongest point focus result here, but this is conditional on supply 30-day treasury, credit ETF, and OS path. It is not a standalone live macro focused. And then we have a student T predictive distribution result. And here we select student T over Laplace for every mid-model horizon. And this confirms the corporate bond focus areas are materially heavy tailed. And then we have the results for uncertainty calibration. And we can say that in 30 days, the supply scenario model produces a substantially narrow interval than the live model while maintaining a similar coverage. And the third part is the change since our previous round's result. The previous presentation last week reported the following legacy headline improvements. We have the 1 day and 1 week, and now our current results, now the new estimates are lower. The difference comes from the tightening evaluation and implementation. We use the source time safe feature availability, temporal purging, and corrected code validity, event level buttoning, and straighter like point time joins. And the current results supersede the previous one because they are more representative of deployable performance. And the legacy and current percentages should not be interpreted as a like-for-like deterioration in the same test design. And here is one model like generally improved this in the current framework. Now we have, as you can see, we have both improvement from 1 day and 1 week. And here, the larger progress since last round is the addition of capabilities that were previously unavailable. We have a full 30 calendar day focused pipeline, a 26% 30-day supply scenario MAE environment, and student T evaluation at all horizons. And now we have a temporal robustness. The 1 day and 1 week rotating models can be the carry on MAE and not NLL in all 7 test months. And the 30-day direct scenario model also beats the carry in all 7 evaluated label months in the common split full data analysis. And also we have some changes in methodology and implementation. The first one is a validation rotating factor residual. This scenario model actually would decompose the bond price movement into systematic and bond specific components. We have the last trace price and rich systematic factor move, as well as the quantile HTB bond residual. And the validation then selects like how strongly to trust the factor residual focus in each road. We have the carry forward plus alpha times factor minus residual focus minus carry forward. And now we have a duration aware 30-day factor model. And the new 30-day stage one model includes interaction between the maturity and treasury shocks, duration and credit spread shocks, duration and the LQD HYG returns, investment grade status, and rate credit moves. Here, our model selection process compares 3 target definitions and 3 weighting schemes over 4 expanding temporal folds, and price data weighting was selected as a and best carry in our alpha folds. Here we also have a predictive likelihood, and distribution layer now compares the Laplace and student T likelihood, and student degree freedom and scale are selected using validation residuals. And also we have a temporal stability testing. The weekly pair losses evaluated using a 4-week circular moving back bootstrap. And then it's a live macro scenario experiment. We tested like whether system focused is on 30-day treasury, ETF, and OS path. And expanding validation compared rich, a lag is 30-day move and zero change. Zero change one for all 12 macro targets. And fitting rich focused into bond model improved MAE by only approximately less than 1%, which is below than 2% plain live model result. And this week's negative result is important because the model is currently stronger as a conditional scenario engine than a standalone macro focused. And here we add a new part to our model, which is a hypothetical scenario engine. Basically, here is a summary and heat map for our new engine. We basically control all the variable and choose different scenario to say how the treasury path and credit ETF paths and OS paths going to change. And from the result here, we can say the long HY and long IG bond have a median credit stress impact of approximately -2 and 2 price points versus approximately only 2 for long IG bonds. And this outputs are conditional model sensitivities, so not the causal estimates or predicted macro path. And for the next one, we will we will try to better we'll try to better incorporate all of our project with a XOR benchmark. And here our final takeaway is a 26% improvement for 30-day supply scenario MAE, as well as 30-day student T negative log likelihood. And that's it. I'm sorry, I think you muted yourself.
Oh yeah. I was just saying that's a huge improvement over carry forward 26%. And negative log likelihood. How do you even compute a negative log likelihood on carry forward? Do you just construct like a static distribution around the carry forward?
Yeah.
Yeah, okay. All right. Yeah, okay, that's a huge improvement as well. All right, awesome. Okay, let's move on to project 4, inventory valuation risk and auto hedging. We have somebody for that?
Hey guys, good morning. Let me just present my screen. 1 second. Okay. Are you able to see my screen? Okay. So I'll start from the last result. These are just the previous results that we have. And this was our final result from the last stage. So these are our numbers for the single tenor. Single tenor is basically like when we are hedging the inventory with just 1 year yield, I mean 10-year yield, just with one tenor. And then the key rate is like when we are hedging with the whole tenor, 2 year, 5 year, 7 year, 10 year, and other tenors as well. And then these are the numbers for the hedging. And then in last part, first I'll come to this part, the hedging cost assumption. So in our whole project, we are not taking anywhere like hedging cost assumption. Like when we are hedging, there was nothing cost assumption. So first thing we implemented is the cost assumption. So because we are hedging with the treasuries, we need two things. First is the financing cost, which we already have the data from so far bundle, which is already present in the final data bundle. So I have just like taken the data from the so far dot parquet file and then computed the final financing cost for the hedgings. And the second thing is the bid cost offer. Bid offer cost spreading for the treasuries. And I was looking for the data, but then I was having some difficulties in finding the data. Maybe I'll text you, Nathan, for this as well. And so, yeah, uh, as of now, the whole financing cost is just like dependent on the, whole hedging cost.
If you go to the deepmm dot data bucket, and then inside there's different folders for the different data sources. If you go to the TPI cap one, which has a raw bare metadata, it's in like XML format. But I think that might have a bid offer in it. You can check. I'm not totally sure, but you can check and look at some of the examples. And we parse that and take out of it what we need, which is currently just a mid into the parquet. But yeah, you should be able to look at the raw data source
You said deepmm.data and then TPI. TPI is the folder name.
TPI cap.
TPI cap. Okay, I'll just take a note and then have a look at
Yeah.
the data.
If it's not what I'm remembering here, let me know and I'll help you find it. So
Okay, I'll text you after this.
yeah.
So this was the hedging, the cost assumption part that we made on the hedging. So this was not present earlier in our project, and now it's there. The second thing is the bootstrap confidence interval. So previously we like every metric that we are pointing in our research, like delta R or delta V, or the other metrics as well, like VAR or expected shortfall. Everything was just like a fixed number, and nothing was confidence interval. So what we have done, so we have like taken a sample of around 2000 samples, and then we randomly selected the value of delta R, delta V, and other values as well, and we bootstrap the values, and then we made like confidence interval out of that. So it was based on like two approaches, but then I think finally we'll just gonna stick with one approach. So first approach was because we have almost like 10 dealers. So we take the metrics like delta R, delta V, and other metrics for all those 10 dealers, and then randomly selected the values 2000 times, and then taken the like middle 95% values of those whole sample. And that's how we build our confidence interval, and this is valid for every metric that we have in our research: delta R, delta V, expected shortfall, or VAR, others as well. And after doing all of these, so these are our final results. uh, we can see some changes on the initial results, and we can see the confidence interval as well on metrics like delta V, delta R. Expected shortfall and VAR is not present on this slide. Uh, but yeah, the confidence interval are valid for those metrics as well. And limitation, same story as we said last time. So 35% of data is only available. I'll not go over this. Yeah, so next step, bootstrap confidence is already done. finalize hedging cost assumption. We have almost implemented this as well. Just one part is remaining. I'll look for the data and then implement this as well. Freshness abolition. So I was looking for this, Nathan, and I was not able to find any method like how I can lag the data maybe by 15% or 30 minutes. So like, do you
Oh
have any?
yeah, yeah. For that, you'd have to basically query you query the production server in the present, like with a zero lag, because like there's a new model out, so the old data set is out of date. Um, and then you would query the API for timestamps that are increasing lag. So so that's how you can collect the data that's aligned with the trades. Um, does that make sense?
No, I mean, I didn't understand.
Oh, okay. So with our
Maybe-
API, you can query an inference that is based on a timestamp.
Mhm,
And so first you can get the same inference that is currently in the trade matched file in the Atlas historical file.
mhm,
Because and the reason to do that, first of all, with zero lag is because that file is now out of date versus the production servers. They have an updated Atlas 1.1 model rather than the 1.0 model that you've probably been using data from. And we also actually have historical data for the new model that you could access as well. But anyway, once you've gotten for zero lag, then you can go ahead and query the API for timestamps that are increasing in
okay.
lag. So you'd have to, yeah, you'd have to use the server, the staging server to do that. But yeah, then you could do that. What question I have, could you go back to the results slide?
Yeah.
So it looks like on here, actually, BonkLeak performed the best. And, you know, most of the
Oh,
other intern project, oh, go ahead. Uh,
yeah. So if you see on the bond click part, the delta V value is only performing better for the bond click. But when we hedge the book with the treasuries, it's performing the worst. So when we,
oh, okay.
yeah,
I see. I see.
yeah.
All right. Yeah.
So I
Got it.
mean, we are shocked with that result, but I think this is consistent with other teams as well. And other
Yeah.
I know other teams are also having similar results. The
Yep.
bond click is not performing better.
Yeah. Yeah. I actually just terminated my contract with BonkLeak because I you know our team like had previously done a bunch of evaluations to see if we could get our model to be more accurate by using BonkLeak data as an input to the model. And none of those experiments, except well, we had one experiment that one person did a long time ago where it looked like amazing results, but then we could never reproduce them. And all the other experiments we did showed zero benefit for including it. And now with these intern projects that also show that it's like the worst data source in terms of accuracy, I'm like, yeah, like we should
Yeah.
because like there's no point in keeping paying for this when we're not getting a benefit. And by the way, when you put this into your paper, I would rather because I'm still kind of friends with the founder of BonkLeak, I would rather you not embarrass him too much by saying BonkLeak in the paper, but if you just say like you know, a
Coach.
source of runs data or something like that, it would be great. So
Yeah, something like quotes number or quotes data. Like not specifically saying the bond click as a word
yeah,
keyword, just like quotes of the corporate bonds, right?
yeah, something like that. I mean, the most commonly used term for this type of data is runs data, but I think quote like soft quote data is another way of saying it too. So yeah, either way, yeah,
I think Nate, you can maybe formulate it in the way that trace is still preferable. Let's say winner versus other data sources or something like that.
yeah, yeah,
Okay. So yeah, I mean these are the results, and as a next step, only one thing is remaining, lagging the data and then checking its accuracy. How does it perform? And the hedging part is almost done. And overall, we found out the Atlas model was the like one of the best model from the three data source that we have. The last trace and the bond click and the Atlas. Atlas was outperforming every data that we have tested. Q1 of 2024, Q1 2020 or 24, and then Q3 as well. And the Atlas was performing better, like 14 to 20%. So that was like the whole thing. And now further we are working on our literature part. We're already working on a draft version, and then maybe we'll preview the draft as well in next slide. So that's it.
Cool. Thank you. This is good. So appreciate the hard work, and yeah, excited to see a paper come out of that. So
Sure.
okay, let's go on to project 5, buy side best execution and broker selection. Do we have somebody representing that team?
Hi, Ethan. I'll share my screen.
Yep.
Let me know when you can see it.
Yeah, I can see it.
Yeah. Okay. So what we did over the past few weeks is like study these three factors, which we think drives a lot of the P&L. That is relationships, as James mentioned over the email, information leakage and competition. So information leakage and competition are for the ATS case, where you're trading electronically, you're revealing side to everyone, but you also have a competition benefit. And so they tend to counteract on the ATS system. And so we've been studying that. Relationships is it's mostly about in our project, the way we are quantifying it is how many times you're rejecting a dealer while trading. And so like this is important because if you're perceived to be a problem account, then you just have trouble getting a block trade done. And we have tried to add that effect into all of our simulations. So these are the agents that we study. We have a last price agent that just looks at the trace tape, picks the last price, and that's his pricing benchmark. We have the VWAP agent, takes 5 trades from trace, and that is his benchmark. We have the Atlas preview, which has access to a price distribution and uses the P50 as the benchmark. And we have a round robin agent, which does not do any dealer selection, just like cycles through all the dealers mechanically. And for the first three agents, we have a memory and memory-less mode. So in the memory mode, it can remember a dealer that satisfied its criteria and then stick to it as long as it keeps on satisfying the criteria. So it reduces rejections uh, in that case. And the criteria for all of these agents is like pretty much similar, which is if a quote is more attractive than the pricing benchmark, the agent trades with the dealer. So, for example, if you're the Atlas preview agent, use P50 from the output as your benchmark. If you're buying, if like the offer is below the P50 offer, you'll make that trade. Similarly for VWAP, like if the offer is below the VWAP price, then you'll make that trade. This is the simulation setup. We had sampled 100 QSIPs. The reason why it is this low is because it was just taking time for us to calibrate the simulator to every single QSIP. So right now, we are at 100 QSIPs. This is how we penalize rejections. So we have the base case fill probability, and then we multiply it by a negative exponential. So as end rejections keep on increasing, like the fill probability overall decreases. And this has an effect on if you're doing a block trade, for instance, where the probability is already pretty low of getting filled. If you have been rejecting that particular dealer, it's pretty much sure that you're not going to get filled because of this model, depending on lambda, of course. And you have information leakage, which we spoke about during the last several weeks. So like this is the main experiment which we did, which is experiment one was just complete a bunch of voice trades, ending with a bunch of block trades also done over voice. And we did a parameter sweep over the relationship penalty. So it starts off from a very low penalty, goes up to a very high penalty, and then looks at how the agents are performing. And the second experiment was an electronic probe. So the idea is to see can electronic execution improve total performance. And it goes on in 3 different phases. The first phase is where all the agents learn the panel and figure out which dealers satisfy their criteria. The second phase is they execute an electronic trade. So if you're an A2A agent, you just blast it off for the other agents, once you've found the dealers who match your criteria, you only use them. And then there's the last phase where you try to execute another block over voice. So what you're trying to find out over here is, okay, fine, you get a competition effect on the electronic trade, but can you also get good execution after that trade is done? The two main metrics that we are looking at is the VWAP improvement, which is the VWAP of so for a buying agent, this is the VWAP of the round robin policy minus the VWAP of your policy. So for a buying agent, if this is positive, that means the policy spends less. So that's good. And we have a savings sharp. So it is the mean of the improvement divided by the standard deviation of the improvement. And the improvement is defined to be zero for the round robin policy, obviously. And we basically run the simulator for all the QSIPs which we sampled for. So these are the results for experiment one, and I'll maybe like take some more time to explain this. So what we found the agents were doing is, for instance, if you're a VWAP agent, you tend to lag the market. And so your own pricing benchmark is a lot more aggressive than the P50. And so you reject a lot of dealers that are actually favorable. And so what that means is once we uh, like increase our relationship costs, agents which are not using Atlas get penalized a lot. And we can see like the mean improvements for the 20 dealer panel, where the last five VWAP actually wins. So its mean improvement is 0.25. The sharp of the improvement is also like 1.85 versus the Atlas agents which are not performing as well. But as soon as the dealer panel is shrunk, so when the dealer panel is getting shrunk, if you have bad relationships, that matters a lot more now. And like the Atlas, the agents who are using Atlas, that completely blow everyone else out of the water, because it's like saving that relationship matters a lot more if the panel itself is smaller. And so we did the experiment for an entire grid of lambdas and dealer panels, and we can send the CSV as well, which is a more detailed report. But this is like our summary of what is going on. So, like previewing and having a better price distribution over voice, it matters a lot more if like there's a significant penalty to rejecting a dealer, and also if like the dealer panel itself is smaller. The second experiment, which is the electronic probe. So we compared three agents. We had one which was using Atlas, one which was using VWAP of the last five trades, and an A2A RFQ for the electronic trade. And what we found is like the Atlas model, it works the best, but it starts to underperform once the information leakage parameter is increased. So we are doing a sweep of the parameters starting from 0 to point like 0.015. And as you can see, like the agent which is doing A2A starts off really good because it has no information leakage, has all the competition benefit, but falls off very quickly. And so does like the Atlas agent, but the last five VWAP agent, it stays more steady. And the reason for this is again like because it has a more aggressive benchmark, then its panel size itself is much smaller. So the A2A full RFQ panel size was 20. The Atlas agent has a panel size of average panel size 9.83, while the last five VWAP has 6. And what that means is it gets rewarded when information leakage is very high, but it cannot make use of like the competition effect as well when the leakage is low. So like if you could assume that for an IG bond which trades a lot, if the lambda information is pretty low, then using Atlas is the way to go because you can make use of uh, like make good use of the competition effect on the ATS market without having a full blast and revealing information. So this is what we basically found is that better pricing in terms of dealer selection, this is what it basically does, which is firstly like relationship management. If you know where the market is, you know who's favorable to you, who's not favorable, who's axed, who's not axed in your favor, and you don't reject as many dealers as some other agent which just happens to have a very aggressive benchmark. So, for example, if your pricing benchmark happens to be like the P25 of the actual market, then you will reject a lot more people than someone who knows where the market is. And similarly, for the electronic venues, having a pricing agent tells you, it can give you information of like when you're trading before of who's favorable, who's not favorable, and can allow you to create a cohort of dealers that you want to target during the electronic RFQ. And it can give you a good set, which gives you like a balance between having too many dealers and not having enough. So those are a few things which we did, like the two experiments where we showed that how having a pricing agent is useful. The things that we are going to work on moving forward is we are going to add a realistic error to the distribution to see how the agent performs once you add in a lot of error. And secondly, like as Samson, like we're still working on uh, a reinforcement learning agent which can actually learn how to switch between venues. We haven't done that yet. Like we haven't been able to build that. But I think like what we have been able to establish is given a trade schedule, having having something like Atlas does help you in dealer selection, basically.
I'm really glad to see this all coming together because, obviously you guys have a lot of pieces to put together for this to work. In terms of you have to simulate the dealers, you have to simulate the clients, you have to
Yeah.
simulate the all of the economic incentives that they're put under. So, anybody else have questions for Arian and Samson?
May I quickly ask, in terms of RFQ, when you form, let's say, an RFQ, what is the logic to include or exclude dealers? And it was just it was a fully disclosed RFQ pipeline, or you have, let's say, some ideas about the anonymous trading, something like all
Yeah.
to all.
So in the RFQs, we have two cases which the simulator allows for. You always have to reveal your side. You don't have to reveal your identity, and you can do like an A to A blast, or you can like choose a bunch of dealers. So for our agents, we did I think benchmark against the A to A blast, but for the preview and the VWAP agents, what they do is in phase one, they learn about the market, they figure out who their favorable dealers are according to their own benchmark, and then use them during the RFQ process. Like, does that answer your question?
Yeah. Then when you say full RFQ, you always mean A to A.
Yeah. That's right.
Okay. Okay. Yeah. Thank you. Just have some ideas here, but yeah. Thank you.
Cool. Oh, and George, you should be able to see everybody's email on the calendar invite in case you want to reach out to anybody individually and ask, more detailed questions later. So,
Sure. Thank you.
or anybody else, or anybody else that's on the call and wants to ask more detailed questions of the interns, that you're welcome to. So, all right, thank you very much. Let's move on to portfolio trading and list trading optimization. We have somebody for project 6. If not, we'll move on to project 7. Okay, let's move on to project 7, relative value screening.
Yep, I can do project 7 right now. Yeah, I would go first.
Can you guys see the page?
Yeah.
Yeah, okay. So good morning. This is my update on project 7 on my work. I would say the work are almost finished, and I will cover the select models and its main results. And my plan is to finish the full paper and code it today or tomorrow. So basically in July, I test simple rules like GBM, gating, ranking, and other models using DPM fair value, boundary IQ, trace, and all other market data. Well, I would say some models made money, but several complex machine learning models performed less well, I would say, and with the profits concentrated on a few unusual dates. So from this test, I select the LQD ETF gate model. It gave the stable positive result in mean test and was easy to explain. The ETF rule gave a direction, and the deep and fair value signals decides trade or cash. This gave us a direct comparison between the same model with or without deep and fair value. LQD holds investment grade company bonds, so it gave us a very direct channel for this fair value gate. The direction came from the reversing the previous LQD return. DeepM Atlas fair value and boundary IQ decide whether to trade or stay in cash. The exact position size, holding period, and exposure limits are shown in the rule box on the screen. So please look at the LQD table right here. It compares the same rule with and without DPM fair value on two samples, and both show improvement from the gate. The stress tests below remain profitable under higher costs and after removing the largest winners. I will leave the exact figures on the screen. The main point is that the ETF rule performed better when the DPM fair value signal controlled capital use. I will explain more in my paper for the details on how DPM fair value improved the LQD model. So then I test the same gate across a broad set of ETFs, position size, holding periods, and other code settings, all kinds of parameters. TLT ETF gave the best observed mix of returns, Sharpe ratio, and liquidity. So I selected from the test result. The chosen parameters on the screen. It's basically 20% of the reference account and hold position for 920 days. I think one possible explanation is that the TLT ETF and the company bonds both respond to the interest rate and the duration. Now please look at the TLT result on the screen. I will highlight only two numbers, the approximately year return was 7.1%, and the historical Sharpe ratio is 1.97. The table also shows the total result and the improvements over the no fair value version. I will leave these figures on the screen as well. The right side of the figure compares TLT with and without deep and fair value. It shows that deep and fair value signal remained important after move from the LQD to TLT ETF. The exact difference is on the screen, and the full calculation will be included in my paper. So the test model used Atlas. I also compared Atlas with the new model on the same bonds. Their central price were very usually close, while the new model often gave a wider range. Probably the new model maybe later be useful as a extra risk signal. So the main result is almost complete. Today I will finish the paper and send it with my code. And finally, I want to thank you, Mr. Power, for his support and help with the data and resources. This is kind of my first chance to work on a project with such clear practical value. And thank you all, guys.
Thank you, Roger. This is good to see these results, and I'm excited for the paper. And let's move on to project 8.
I think I passed. Is Andrew here?
Oh, is Andrew? Oh yeah, Andrew. Did you have separate results to present? Okay. Maybe, yeah, let's just go on to project 8 then. Liquidity where portfolio rebalancing with Alex, Song, and Arian.
Hello.
What's up? I'll share my screen right now. So, mm, can everyone see the screen right now?
You want me to go first, or Alex, you
Yeah,
want
I
to go
can see.
go through
I
the
got you.
whole, and then we'll forward to me. Oh, you want me to go? Okay.
Yeah.
Um, so with the continuation from our last presentation, this is our enhanced threshold design strategy. Just a reminder from our previous presentation, checker similarity is about keeping the items of the common portfolios and making the and keeping how much of the retaining how much of the similarities in terms of the portfolio stack optimization. So like last time, we one of the aspect we made in Ace was that checker similarity was quite low in terms of day to day because the daily portfolio stack in terms of the ranking was switching a lot because our internal liquidity inputs had a huge divergence. So now we are down. We designed so that our portfolio stock is around like right now it's like divergence is around like 30%. So it's like around like 70% of the portfolio is retained each of the day. And the strategy that we enhanced was that instead of using a daily ranking internal liquidity divergence in terms of the liquidity, we made a persistent ranking strategy where um, the bonds that are already in the portfolio, let's say once they enter within the ranks from like 1 to 5, then that portfolio of the ranks are like retained each of the day, and only exit if the portfolio of the ranking goes outside of like seventh rank. Then in this way we can retain and have a more stabilized checker similarity model, and therefore the divergence of the our computation model can be much more stable when we design our threshold. And also, and also like in terms of the y-axis, we designed so that our y-axis can be that in terms of our y-axis can be that it is a liquidity model of where we see we implemented the price divergence aspect as well, so that it is trace. So we saw price divergence as trace minus x, or as the as how much we see the price diverge from the actual from the traded price to the our liquidity internal model price, and then we subtract that by our internal liquidity model of x or liquidity model, and then we see that as x-axis goes to the right, the implication is that the price divergence signal and liquidity signal are giving more consistent ranking as at what x-axis goes to the right. So we see that from our, and then we so and from the threshold we have a much lower divergence in terms of the checker similarity, and then also we see that as we approach to the y-axis part of the threshold right bottom of the quadrant, we see that there's a much more stability in terms of low divergence, and also a closer of our inputs of price divergence and liquidity model. So we designed such that this is what the moments of the trades where they can be automated, and also like the left and top part is where there's instability in our in the model, so they can be like the ones that are not trade. So our like enhanced design of the threshold simulates the model to be either automated or not automated, or like manual based on our iterations of the test.
And that is like one of the updates we got for this week, that we're trying to like finalize it and see if we could like put on the paper, because right now our setup is pretty much mostly done, that we're trying to just like apply like extensive stuff on it. And I'm gonna just like do a little summary of like our whole setup right now, like what we're doing and what the paper is gonna be talking about. So starting with like the basic setup, like for data, I'm just using like trading days for like April 2023 to September. And I do like a little like basic filter for like data cleaning. And like the main setup that we did for like the model is a MIOP, whereas we have two stages. And the first stage is based on the liquidity. We're trying to have like a choose like the top bonds with like different liquidity score, which the liquidity score it's like stuff I mentioned before, so I'm not gonna repeat once again. And stage B is like based on the results on stage A, whereas we maximize the liquidity score, we're trying to like preserve like a certain amount of it, which is I'm gonna mention little bit later, which we find like optimal like amount of threshold of like 95% to like of like liquidity like remained, and then in that liquidity we're trying to minimize the transaction cost. And I'm gonna start on our results of like our model, and our result is pretty much based on two different metrics, which is first on the Sharpe ratio, which is like the most easy to see, and second is we decide to use something we call like the automation gate to like decide like if the liquidity score is like too large or too like small for us to like decide if it's like not suitable for like, automation, which is kind of linked to what Sang said before. I'm gonna move to the result part, and I'm gonna keep it simple. Like I'm pretty much mainly focusing on the comparison between the LXOR, like our model liquidity, and like the trace liquidity. As on the bond click hill, the data wasn't really that good, and like sometimes it's not really present, so it's like hard to make comparison. So there's like the main comparison I'm gonna make on. And in the result, we could pretty much see like how AXOR is like pretty much being more like competitive or like in like a better side comparing to the trace, as we could see on the graph on the top left, how like the AXOL curve is always on top of the trace MRR. On the top right, we could see like even though both like starts at 0, the LXOR ends at 1.4%, whilst the MRR goes to like a negative 6.9%. And that 5 like around 5% gap is pretty much because of the transaction cost. And that transaction cost reason could also be seen in like our graph in like the bottom right, where we could see how like the gray curve, which is the MRR, is around like a 0.4 range, while like the orange curve of like the AXOR is like a lower curve, suggesting that in our AXOR, like we choose like bond more selectively, and we don't really like switch out our bonds like daily as often as MRR to show that how transaction cost is being lowered in our AXOR model. And as you guys can see, the Sharpe is just better in like AXOR. All right, I'm gonna move on to our some of key findings. And our first key finding is kind of what I mentioned before on our like two-stage MILP. I just do a little like swap of the torrents to find the optimal amount. And as we could see, as we get to like the 0.95 range, like as we go down, the Sharpe ratio is pretty much in like a saturated like stage. So we decide to like set it up for a 95% in our like stage B MLP, which I mentioned before, for like a good Sharpe like improvement. And the second metrics I mentioned a little bit before is the automation. And our automation is pretty much based on like the differences in our price signals. And as I mentioned before, sometimes the bond clicker is not really present, and we'll use like just like differences between the spread. But like if all of the data is like present, we decide to use standard deviation if it's presented. And the main like result as we could see is we could see that AXOR has like a 84% of automation rate, while your Chase RR have only have like a 63%. And I think the major explanation for the difference in the data is because us our mean like dispersion rate for like both two like signals is kind of similar, but the main difference is how in the trace data the mean dispersion, the mean max dispersion is like 3.4%, while for like the AXOR is like 2.5%. I think that is the main difference on why AXOR is just a better setup for like trace RR for like automation, as it kind of limits out like the outliers and stuff when they're choosing the stuff. And go to the next slide. I'm going to talk about a little about our like regime analysis. Our regime analysis is pretty much based on like a Fed reserve policy dates, which on like the result part we could just see like AXOR is actually performing the best when it's like a more like stress environment, when it's not like as expected. And for the regime analysis, like the date I did is more like I picked up by manual, but like after that I kind of validate my date using like a hidden Markov model to like justify how the data is like pretty good. I haven't really have like a graph here, but like I'll show later words like how like the manual did and like how I use the HMM hidden Markov model to like select data according to like different like Fed Reserve dates, and the data is kind of similar. But all in all, like in conclusion, just pretty much saying how like XOR is like performing the best when it's like not that expected. So yep. And I'm gonna talk about something that AXR didn't like particularly like is in like a good spot or like some like part shortcuts or constraints. So first of all, I want to refer back to the dealer to dealer signal that I was trying to use it on the AXOR. I was trying to use that for the MILP. However, I think the information wasn't really that full, and only like 25% something is like being covered. So I think it's not really a good signal to use like fully through the model, and something to keep in mind. And another thing to keep in mind is how AXOR actually have like a slightly worse checkered trade least checkered stability than MRR. Like MRR holds the same bond for more consistently day to day. However, AXOR rotates bond more frequently, even though with smaller rate changes. And that's like something that we should put in mind of. And I'm gonna end it with like some limitation we have so far for a model. And I think the first two I already mentioned, the clip-on and the dealer to dealer, like the data wasn't really like fully presented. And the last thing is for our transaction cost, we just use a spread approximately, and we didn't use a actual exception like cost to like estimated transaction cost. And that's like some of our like constraint or like, limitation that we're trying to get done with. And we're trying to move on to writing our paper, which we're already starting on, that we're on like the model part, we're like kind of halfway through, and see how we could like put our stuff into a 8-page paper. And that's pretty much what I got for today. Thank you. I don't know if anyone got any questions.
I think
So,
Nathan,
anybody have any questions?
A quick question. What is the liquidity score here?
Gotcha. So the liquidity score is pretty much I kind of use like different methods for like different inputs. So like the three inputs that I was like looking at is pretty much the trace, the bond click kill, and the AXOR model. And for the trace, we're using different like math like row like methodology, but like at the end we decide to use the MRR methodology. And for like the bond click kill and like for like the XOR like our deep payment model price. For the deep payment model price, at first I was trying to use like a little bit like dealer to dealer, but like the data wasn't really fully there. So like for bond click kill and like for AXOR, like for the graph that you saw, it's like mostly the liquidity score is based on the spread, and I just normalize it so I could like compare at the end.
Okay, thank you.
Thank you so much.
Um, no, I just got nailed by Nerf guns from my kids, so they may come back. They just burst into the room. Um, so yeah, this is good, and I want to say to everybody, congratulations on getting so much closer to having your research papers ready. And it seems like for most of the projects, we're pretty close to having drafts or improving drafts that already exist. So yeah, I encourage you to work with faculty wherever possible to review those. But also, I'm just excited to see them available. And obviously, as soon as you guys have them on archive, at least a draft on archive, please give us a link so that we can post it on LinkedIn and our website, etc. Um, and then the other thing to mention is we might take clips from this meeting and other meetings we have to start posting those on social media. So thank you for that. So thanks for everybody here that was prepared and was able to give a good presentation. And another update is that I'm working on getting to a closed beta, a new model that is way more flexible on the input data, meaning that it can be applied to many different asset classes or even non-financial use cases for forecasting and decision making. So hopefully in the next couple of weeks, we'll be able to preview that to you guys. So I'm excited about that. And I think that's about it. Anybody have any questions? So we'll plan on meeting again next week. It seems like this is a good time for some people who are overseas right now, but let me know, like send me an email or a Slack and let me know if this time did not work very well for you, so we can think about what time to schedule the next meeting. And that's it. Thank you very much for everybody's time.
Thank you.
Thank you.
Mr. Powell, appreciate it.
Thank you.
Go on.
Thank you.
Thank you.
Bye.
See ya.